Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 28th of May. I'm Daniel Lam, your host for the podcast. Many of my colleagues are talking about summer holiday plans, and a number of them are going to Japan, although they have been complaining about the recent strength of the yen versus the Hong Kong dollar, which is, in turn, pegged against the US dollar. Now, we must not ignore volatility in Japanese assets. They often act as a warning sign for investors. So, for example, volatility in the yen can be seen reflecting broader market stress and dislocation. And there have been examples for the last 2 decades where volatility in the Japanese government bonds, i.e. the JGB, very often preceded volatility shocks in other markets. So for example, back in June 2003, the surge in US 10-year government bond yield was preceded by a 100 basis point increase in 10-year JGB yields. And 10 years later, in May 2013, the taper tantrum set off a VAR shock across global bond markets. And note that the 10-year JGB yields had already risen by 70 basis points in April 2013. The rising yield is the biggest threat to financial markets over the next few months. Now, 30-year JGB yields have already bounced by 100 basis points since the start of April this year. The bond market is reflecting concerns about fiscal stimulus and its implications for debt levels. So for example, is there enough tariff revenue to cover the cost of the Trump tax bill? Is there sufficient incremental economic growth, and does tax revenue to pay for tax cuts? Can the US budget deficit narrow? All these are causing worries amongst market participants. So this explains why the yen has been strong and the dollar-yen once again testing the important support at 140, which was reached twice back in the middle of September last year before the Trump rally started, as well as towards the end of April this year at the height of the bearish sentiment on risky assets before the thaw from US and China on the trade tensions. This time around, there's reasonable chance for the dollar-yen to fall below that 140 level. This is because Japan inflation has not shown any signs of deceleration. For example, the Tokyo CPI surprised to the upside in April. So this is usually a very reliable leading indicator for national inflation. Both core and core measures ticked up to 3.5% and 3% respectively, both above consensus expectations. So this is putting the Bank of Japan in a tough spot because these hot inflation prints came after the BOJ surprised markets by leaving policy rates unchanged, which was a dovish pivot. So these data may force the hands of the BOJ to turn and tighten their policies and lending strength to the yen against the US dollar. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.